Welcome back to my channel, Balance Sheets Matter. Today we're going to be looking at a Roblox because of course nowadays all the kids, they want Roblox and Robucks, and this was a subscriber request video. But before we get into the analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do stock analysis videos, so if you want ideas of potential stocks to buy and other stocks value traps to avoid, make sure to subscribe to my channel. If you do want me to look at a stock, put it in the comments below and it might be covered just like this one. So let's get into the Roblox analysis here. Jump into the 30-year financial. Of course, this is a fairly new company, so there's not a lot of financial history, but we'll look over what we can right now. So we can see basically the revenue, when we look a few years ago, it was quite low, and it has grown quite a bit, but it is starting to slow down a little bit. Basically at the year end of 2022, December 2022, they had about 2.2 billion in sales in the last 12 months, which overlaps a little bit with 2022. It's only 2.4. So we are seeing a deceleration with growth. And for basically a company that effectively right now just is one game, we can't really expect too much growth in the future for this one game unless they really expand out in other verticals or maybe create some other games. The one good thing is the gross margin is quite high, but this would be expected in basically a video game or kind of like a tech company like this. Selling and general admin expense, actually relatively low. Most of their money seems to be going to the research and development, and this is probably all related to basically designing and building those video games and doing new features, etc., which is their core business. But unfortunately right now, they're spending a lot on research and development, so they're losing a lot of money, and their operating income is at negative $1.2 billion, which is not very good right now. And this has been going up and up and up every year. So this company is losing a lot of money, and we're going to need to see if they are going to be looking for some profitability in the future. And yeah, net income again, still losing lots of money, and the shares outstanding is going up because they slowly are diluting shareholders, mainly from stock-based compensation though, as we'll see a little bit later. So we go down to their balance sheet. The one good thing in their balance sheet here is they currently do have a lot of cash and cash equivalents, although this has ticked down because, well, they are losing money. You can't basically expect them to be sitting on having all that cash as they're slowly losing it over time. But total basically current assets sitting at $2.9 billion. We look at compared to their total current liabilities of 2.6, a positive current ratio. They can cover all of this, although a lot of this is just current deferred revenue. So this is basically just revenue they've received cash for, but they haven't expensed yet. So this really isn't current liability that they are going to be having to fork out cash for. It's just going to be, affected their total equity down the road when they realize this revenue. So overall, basically the current ratio is actually a lot better than we're originally seeing. Total assets are sitting at about $5.6 billion and not very many intangibles, which is kind of surprising for a video game company like this, with only 134 million goodwill and total intangible assets of $194 billion. It does look like there's a lot of plant, property, and equipment, which is most likely related to their servers and other computer-related stuff like that. And depending on how exactly all that is, I know a lot of that ages quite a bit, so there is going to be some replacement they're always having to do for that. So it's very possible that what we're seeing here may be a little bit overstated from the actual reality, depending on the actual real depreciation schedule compared to the actual usefulness of the product. And then their total liabilities basically 5.4 billion. Again, remember a lot of this is just current deferred revenue, so take this, maybe lower that by about $2 billion to kind of get a more accurate view. They do already have $1 billion of long-term debt, so they have started taking a little bit of debt on the company. And that's leaving a total stockholder equity of 168 million. Again, I would take out that current deferred revenue because when they do realize it, that will bump up the total stockholder equity unless they do lose more money going forward in the future. But right now, there's not really a lot of stockholder equity or real tangible stuff on the balance sheet that I can see. So what do we see on the cash flow statement? We see their depreciation, and right now there's not a lot of depreciating. They currently are doing a lot more purchase of plant, property, and equipment, although this is there's very little history for this, so I can't really determine if they're actually depreciating their servers and equipment there at a much slower pace than they're actually having to replace it, because a lot of this could be disrelated to growth. But this is one thing I would watch for this company, because you're going to want to see if the balance sheet is kind of artificially strong. Are they always having to every year purchase more plant, property, equipment than they're actually depreciating, or are these going to balance out over time? That's kind of something important to look at. Also, you can see stock-based compensation is going up and up every year, and this is quite a lot. In the last 12 months, we're looking at $728 million of stock-based compensation. The only good thing about this is it does actually make positive cash flow from operations. So while they did lose 1.2 billion in the last year, 728 million of that is effectively kind of offset, at least cash going out of their bank just through stock-based compensation, but you are being diluted, so you are owning basically less of the company. We go down the cash flow statement further, and a little bit of issuance of stock is going on every year. We can see there was some basically net issuance of preferred stock, but every year got a little bit. If they do need to raise more cash in the future, they might have to do that. But based on their free cash flow and the amount of cash that they have, this doesn't seem too urgently likely, even though they are losing 1.2 billion or a billion, maybe $1 billion next year. Their free cash flow actually isn't going to be too bad because a lot of that loss is basically being offset by that stock-based compensation. So let's kind of go into the interactive chart here. I want to look at some of the analyst estimates and kind of go over a little bit more. We'll look at the revenue with estimate here. Let's take off the stock price here. And you can see it's like in the next year here, they're expected to start to grow a little bit more. Basically $3 billion or just almost $3.1 billion ending in the year 2023, and then 3.5, and that's quite a deceleration in growth. I think that's just over 10% growth, and then from 3.5 it's 3.8, which is less than 10% growth. So this is what I would say one of the big problems with the company is because right now they just are one game, regardless how successful that is. There only is so much market in the video game market, which is why I have this tab open here, basically comparing some popular games which I think are kind of in the same genre for the younger audience: Fortnite, Roblox, Minecraft, and you can kind of see their popularity in the Google Trends over time. Minecraft, really big boom, and then it kind of faded away, but it's come back a little bit and still has some interest going. And you know, hopefully Roblox, they're probably going to be wanting to look for some longevity like that. In comparison, you see something like Fortnite. Fortnite had a really big boom and faded quite a bit, even though it is still, I guess, apparently somewhat popular compared to when it first came out. It's quite a bit less. And this is the big fear with Roblox here, is that there's all these new games coming out. What is the attention span of your audience? Are they going to want to switch to something else? And you always have to be, you know, putting out something new to keep your audience with you and keeping them engaged. And that's a real big question if they're going to be able to do that. And right now, how I see the business is they really, even though they're making more revenue and maybe increasing, they're still losing a lot of money. And from the amount they're having to spend basically on the research and development, which is, you know, building, improving the games and this and that, I don't really see a clear path to profitability. We put the EPS with estimate here up, and you can see even in the following years, they're still expecting to lose quite a bit of money. So maybe at these losses, comparison to here, it's not like they're going to be losing a lot of cash flow, so I wouldn't worry about them going bankrupt necessarily, but I don't really see a very clear path to profitability with Roblox here. Even if you look a little bit further in the future in more optimistic scenarios, let's say we look a few years more down the line, they're making $5 billion in revenue. Their net margin somehow is 20% because they're spending way less on R&D and they've got a big portion of the market. Well, what is that? That's net income of $1 billion. And then, you know, what's going to be your total market cap on that? Are you going to give them a 25 PE, or is their growth going to be lower and maybe it's only a 20 PE? Some people may even want to give lower than that if the game kind of becomes stagnant unless they come up with something else. But you give it, for example, 20 PE, that'll be a $20 billion market cap. They're just trading under a $20 billion market cap right now. And that's kind of a fair market cap based on these just kind of napkin assumptions 5+ years from now. And that's not even accounting in the dilution that's going to happen. And you can kind of see the stock chart here, not very strong at all. You basically had your kind of, I think they were a SPAC like everyone else, which was doing in 2021. They pumped up, they faded down, they made that lower low, and they've been chopping sideways. And you can see all the price volume up here. Whenever it's getting up to this $40 range, it's running into a lot of sellers. People are selling it. And I think I've said this in some of my other videos, but you have to look at, for companies like this, the current economic climate you're in. When you have a lot of easy money and you can, you know, either borrow cheap money at really low interest rates, or you can basically just issue stock at really high prices like it was up here. Companies like this can do quite well because they can raise cheap capital. But then when you start getting these more higher interest rate times, and there probably will be a recession at some time in the future, regardless if it's a soft landing, a hard landing, whatever you want to call it, you know, consumer spending starts to go down. It's already happening. Is there going to be as much money kids are going to be spending with Roblox And is that going to affect the overall basically sales of the company, or even just the overall interest? Because if kids can't afford Roblox because it's costing them money, maybe they go for a game that's a little bit cheaper to play because their parents aren't willing to give them the money for it. So right now in the current climate, because of all these things, I don't think Roblox is currently very well basically set up to prosper. It's just not the type of stock I'm personally interested in. I like stocks that actually are making money consistent, find them on a discount. Roblox, well, it's speculation, and right now I think the speculation and the price just don't really make any sense with the combination together. It seems very expensive, even for fairly optimistic projections, like I'm saying, about $5 billion down, 5 years down the road. And even if we give them that they're having still some good growth going, 10% above, 25 PE, that's a $25 billion market cap. You really want to pay an $18 billion market cap in this market for something that's, maybe worth 25 optimistically in 5 years. So I know I wouldn't, but I hope this gave you some insights. I hope you enjoyed this stock analysis. Make sure to subscribe to my channel, like the video, and I'll see you in my next stock analysis video.